Yeah, hi, good morning, everybody. Again, a small audio check. I think Sanjeev is the only guy who has replied to that earlier question. If you can hear me, Prashant, Surya, if you can just type a yes so that I know you can hear me. Yeah, Prashant and Surya, I can see your response. So I'm audible to everyone. Yeah, hi. It was a very nice couple of weeks for the market in the last 2 weeks. This is if you can see the chart of Nifty, you can see that it has been on a uptrend, and I'm sure that whatever you have learned in your technical analysis classes, you will be able to make out uh, why and how the markets have been performing like this. Any particular observation that you have made in this market? Anything that you have learned in your technical analysis class? Yes, anything that you have observed in this market movement, which you are able to relate with whatever you have learned in your technical analysis classes. Okay, let me just show you a few couple of things which you will find. Yes, Sanjeev, I can see what you typed when every passive market turns positive. Is that a question? See, let me show you one very interesting thing in the market that has happened. Sanjeev, if you can just park your question for a minute. You guys must have, you guys must have learned about the Fibonacci ratios, and the Fibonacci ratios panned out very nicely for the market in the couple of weeks, or probably in the couple of in the last 1 month rather. You know, as you must have seen the Fibonacci ratios that 50% and 61.8% levels are very critical for the market when it retraces from any trend. So as we can clearly see here, in the almost last 1 year, the trend was something like this on the downtrend, right? So this was typically the trend that the market was following in the last 1 year, like this, and then it broke out. Now it is like a retracement from a downtrend. So obviously the Fibonacci ratios were coming into effect in this particular case. So if you do a quick calculation on the Fibonacci ratios, let me open an Excel. The high for Nifty was 9110 approximately, right? And the low was something around 6850 kind of levels. So which means the market fell by around 2260 points. Okay, so there are two very critical Fibonacci levels. One is the 50% retracement, one is the 61.8% retracement. So if you look at the 50% retracement, which means 50% of this, so if you add back this to the lower support that the market took, you will find that approximately 8000 was one level where the market was expected to take a resistance. Now if we go back to the chart, you'll find that the 8000 level was something approximately at this roundabout here. Okay, let me see if I can draw a line for you. If you can just see my cursor, this is where the 8000 level is approximately. So what we can see here is at this particular point, then at this particular point, after it retraced, it took a resistance at that particular point. So which is nothing but a 50% retracement of the fall that we had for the 1 year. So we can see a practical example of how the Fibonacci ratios panned out here. And then the market took a breather of the rally and then it came down. However, since there was a lot of momentum in the market on the positive side, it retested the 50% retracement level and then broke past it and then went ahead. Now, till what point did it went ahead? So let us see the 61.8% retracement level, which is coming to approximately 80 to 40, 80 to 50 kind of level. So if I have to just expand the chart a little bit for better viewing, see, this is where the market is currently taking resistance, which is precisely at that level, 80 to 40, 80 to 60. So we can see in a practical example how these Fibonacci ratios are really panning out. So if you are a trader and if you wanted to take advantage of this technical tool that we had, so clearly there was a trade that you could do as soon as the market broke past 8,000 level, which was approximately here, and immediately it shot up to the next Fibonacci level, which was 1.8%. And now the market is again trying to test this level. If in the coming week we see this level convincingly been broken, maybe on Monday itself or Tuesday, we are having the RBI policy meeting on Tuesday, then we'll find that the market will move another 200 points very easily. However, if it is not able to take out this level convincingly in the next couple of days, then it is very likely that it will come down to once again close to 8,000 level. So right now it is in a no trade zone, the market. We have to wait and see how this 61.8% retracement level is the market is respecting, how much the market is respecting that level. Okay, so this is just one of the examples that I am giving as a practical demonstration of how the technical tools that work out. So I'm sure you must have also seen a couple of things. So what we'll do is we'll now open the session for your doubts. So any particular topic that you have any doubt you want to clarify, you can now start asking. Okay, so what you have to do is you have to type in your question on the chat place, and I can then see your questions and then I'll revert to that. Okay, so Rupak is asking me to repeat whatever I am saying because his line was muted for the last 5 minutes. Rupak, if you can hear me, what I was not actually, I was just going through few things that we could observe in the Nifty in the last couple of weeks or last 1 month, which is very relevant from the Fibonacci ratio point of view. What we saw was the market was on a falling trend and then it broke past that falling range. However, while breaking past, it took certain resistance at certain levels. Like if you can see my cursor here the market took a resistance, then it came down and again resumed its rally. Okay, then it again resumed its rally. So this particular level where the market took the first resistance was nothing but the 50% retracement of this great fall that was there. Okay, I think the audio is, there is a difficulty in audio. A few people are saying that they are not able to hear me. To begin the class, we did an audio check and okay, so what we'll do is we'll pause the session for a minute, and if you can just let me see if I can get the technical guy online. Hello, are you able to hear me now, Rupak, Shravani, Surya? If you can hear me now, please reply with a yes.
Hi guys, can you hear us now? There was a small audio glitch.
Yeah, Shravani, if you can reply. I think the audio problem at Surya's end is resolved.
Yes, I think the audio problem is fine.
Yes, Ravani also can hear me. So Rupak, you are the only guy. Rupak, you are facing a problem. If you can reply with a yes, we can go ahead.
I think it is fine now. So let's go ahead with the program. And guys, just keep the bandwidth, your internet bandwidth, as low as possible when the webinar is going on. It will help us to take the session seamlessly. All right, Maulana.
Yeah. Yeah, so we'll start with your doubt clearing session now. So if you can just start putting in your questions, we can take one question at a time. I hope you are aware that we are going to do a doubt clearance on the technical analysis syllabus that you had. So anything in the technical analysis module which you are not able to understand, let me just show you the technical analysis module for your revision. So there was a Dow theory, then there were some chart patterns which were discussed. Okay, so there were some oscillators, some indicators like Bollinger Bands, Fibonacci. Okay, so Surya has put a question. Surya wants me to explain clearly the concept of candlestick reversal pattern in bottom and peak. Surya, I mean, before getting into the individual patterns, I think we would like to not get into individual patterns because that will be a very exhaustive thing. I'll give you an overall brief on how it happens. See, first of all, when you are doing technical analysis, the first thing that you have to do is you have to identify a trend. So if I go back to the Nifty chart that is there, so you can see that once you have plotted the chart on a graph, the first thing that you have to do is you have to identify a trend. Now to identify a trend, the most basic way of identifying is to draw trend lines. Now here I have drawn a rough trend line here, okay, because this chart is actually a web-based chart. The tools are not very accurate, but still you can clearly see that there is a trend which is visible. So once you are seeing that there is a trend, there are only two things that can happen to this trend. Either the trend will continue or the trend will reverse. There is no third thing that is possible with a trend. Okay, so once you have identified the trend, the next thing that you should do is you should look at price patterns which suggest that whether this trend is going to continue or whether this trend is going to reverse. Now, irrespective of whether it is a downtrend or an uptrend, there are certain features which are very common. When we talk about reversal of trends, typically what happens is if a trend has to reverse, it will keep on taking resistance. Like say for example, if we are talking about the uptrend, okay, so if a trend has to reverse, it will take a resistance at some level repeatedly. Now it depends on how many times it takes a resistance. Let's say if it takes a resistance twice at some level and then it comes down, it becomes a double top pattern. If it takes resistance thrice at approximately the same level and then it comes down, it becomes a triple top pattern. If we see that the resistance that it is taking is not exactly the same level, maybe slightly above or below the previous one, then more or less a head and shoulder kind of a pattern is formed. So irrespective of the type of pattern or exactly what pattern we are talking about, the concept is important. So what we are seeing is in a reversal pattern, if you're talking about the price patterns, then there is always a resistance, or if you're talking about a downtrend, then there is a support that happens. It can be a double bottom, triple bottom, reverse head and shoulders, or any other kind of price patterns. But what is important is you have to understand that there are two things basically. Number one is the price has to take resistance or support at some level repeatedly, and number two is the trend lines that you have drawn. The price then has to retrace and try and break those trend lines so that there is a confirmation of the reversal of the trend. So Surya, within trend reversal, if there is any particular pattern that you want me to explain, because if we go through all the patterns, it will be unnecessarily a very lengthy session. I hope you understood what I said. Okay, so there are specific questions that has now come in. There are three questions. One is not related to technical analysis. We'll take that question a little later, which is related to the open interest. What is open interest? We'll take that question a little later. Okay, we'll take the questions which is related to technical analysis first. So there is a question on Bollinger Band and RSI. We'll take that question first. Okay, there is more questions. Let me just pull it. Okay, so we'll take the Bollinger Band question first. Just park your questions for a minute. Let me just clear out whatever doubts that so far has come, and then we'll move ahead. So firstly, we'll discuss the Bollinger Band. See, if I have to plot the Bollinger Band on this nifty chart that we have. Okay, let me just expand it a little. So this is how the Bollinger Band works. Now we have to understand that first of all, what is the concept of Bollinger Band? The Bollinger Band basically gives us a range wherein 95% of the market movement will happen. So there is a 5% chance that the price will suddenly shoot above or below the Bollinger Band, but on a 95% cases, the 2% standard deviation that the Bollinger Band represents, the price will always be within that. Now, what is the trading indicator in a Bollinger Band? See, for example, let us, if you can see my cursor here, let us take this example here. The price was touching the upper side of the Bollinger Band. Okay, so the price was touching the upper side of the Bollinger Band. Now, when this thing happens, it is a indicator that the market is on the positive side. However, there is no nothing which suggests that the market will change its direction or how far it will now go upside. There is nothing of that sort which is coming in from here. The trade signal happens when the price starts retracing from the Bollinger Band, any of the Bollinger Band limit, be it on the upside or the downside, and then while it retraces, it crosses the moving a 20-day moving average on the downside. Okay, so for example, in this particular case, once the price had touched the upper side of the Bollinger Band, there was a retracement that happened, and the price started retracing, and somewhere here the price is now crossing the 20-day moving average. So now this is where your trade signal will come. So what you can do is, here you can go short with a target which is the lower side of the Bollinger Band. Okay, maybe not exactly the lower side, but somewhere close to the lower side. Now once again, what we are seeing here is the price is once again retracing from the lower levels, and it has again crossed above the 20-day moving average. So again, what happens is there is a buy signal that is coming here, and your target will be the upper side of the Bollinger Band level here. Okay, so the way to trade Bollinger Band signals is, once you are seeing that the price has touched the upper side of the Bollinger Band, you have to wait till the price retraces. Okay, just because the price has touched the upper side of the Bollinger Band, you cannot initiate a trade based on that particular signal. And once we see that the price is retracing, you'll have to wait till the price retraces below the 20-day moving average, which is kind of the median moving average within the Bollinger Band. And that is where you have to initiate the trade. I think Surya once again is having an audio problem. Just give me a minute. Surya, I guess you'll have to check your bandwidth issue at your end. If you have opened too many websites, you can close them down. It's not required. You just keep this webinar itself open. Okay, I hope Surya, if you can hear me, if you could hear me what I said about the Bollinger Band thing, and if it is clear to rest of the guys, you can see multiple examples here in this chart that we are seeing here. Say for example, in this particular, see, this is a typical example of what we discussed right now. Here, somewhere, if you can see the cursor here, somewhere here the price touched the upper side of the Bollinger Band. Just because the price touched the upper side of the Bollinger Band, there was no signal that the price will now retrace from this level. Instead, what happened was the price kept on moving up. The price kept on moving up, and then from here it started retracing. Now it started retracing, and this red line, which is the 20-day moving average, this is where, once it crossed below the red line, that this is where the trade of going short initiated. And then you can see that it went and it touched the lower end of the Bollinger Band. Similarly here, once it started retracing and it crossed the 20-day moving average, it went ahead and touched the upper side of the Bollinger Band. So this is how the trades has to be placed for the Bollinger Band. Okay, so I hope this much was clear. I hope this much was clear regarding how to use Bollinger Bands for initiating trades. There was another question that was regarding RSI. See, RSI is nothing but it basically shows you the strength in the rally that is there. Okay, without getting into the actual calculations of RSI, basically what it does is it tries to figure out that in the last 14 days, how many times the market was up and how many times the market was down, and when the market was up, by what amount the market was up, by how many points that is, and when the market was down, by how much the market was down every time. And then there is a comparison that is done, there is a calculation that is done, and based on that the RSI levels are derived. So what basically happens in RSI is, what we see is it is an oscillator. So it goes up and then it again comes down. Basically there are certain levels which we follow in RSI. On the upside it's approximately 75 to 80, on the downside it is something below 30. So what we say is, once the RSI indicator it crosses or touches the 70-80 kind of level, we say that the market is really on a overbought situation. Why we are saying that is because the fact that the RSI level is at 80, which means that for the last 14 days there has been so much buying activity that has happened that it completely outpaces any kind of downtrend that might have happened within the last 14 days. So when so much buying happens suddenly, there is always a chance that there is a slight correction that might come. So that is when these are typically time when you should book your profits. Mind you, it is not a indicator where just because the RSI has touched your 70 or 80 level you can go short. No, that is not how the RSI works. What you can the way RSI works is, if you are already long and you find that the RSI is now crossed 70 or 80, that is the time you book profits. Now if you do not have any position and you're looking at the RSI and are trying to figure out when we should enter, then you have to wait till that RSI again starts coming down. From the 80-70 level it starts coming down to 60-65 levels. Then you might say that the momentum is shifting on the downside, and that is where you can probably initiate some shorts. Okay, but just because the RSI has touched 70 does not mean that you can go short on that. There was another query that was asked, was divergence in one indicator is enough for stock to move to bearish or bullish, or do you have to wait for other indicators to show do we have to wait for other indicators also? Now see, in technical analysis there are lots of indicators that we follow simultaneously. Now there might be cases where, especially when the trend is reversing, such a scenario, there will be multiple kind of let's say views that different indicators will give. For example, there are some indicators which are lagging indicators, there are some indicators which are leading indicators. The leading indicators are those indicators which shows any kind of reversal first, and then the lagging indicators kind of confirms that reversal of the trend. So what will happen is, when the trend is just about to reverse, some indicators will show that the divergence is happening. However, some other indicators will say that the trend is still intact and we should stay with the trend. So just following one indicator is obviously not a very good practice. You should always have at least 4 to 5 indicators which you should look at all times, especially when you have to initiate a fresh position. Okay, so if you have to initiate a fresh position, it's always good if a lot of indicators are confirming the trend. So if your RSI is saying that it was in a overbought kind of a territory and then it is now coming down, your ROC is also showing that there is the momentum is now shifting on the downside. Your Bollinger Bands are also showing that it is now about to cross the 20-day moving average. A lot of indicators, simultaneously, when it starts showing that there is a possibility of a correction, that is when it is preferable that you initiate a trade. So just by following one let's say indicator, it is not a good thing. So to answer the question that whether any one indicator is enough, it is normally not enough, because taking technical analysis, there are multiple indicators at time can give you multiple or different kind of views, simply because some of the indicators are leading indicators, some of the indicators are lagging indicators. I hope that answers the question. So you can always have at least 4 to 5 indicators which you are following, and once you get the signal clearly in all of them, preferably, but at least 3-4 indicators at least, that is when you should start initiating your positions. Similarly, if you are having a position already and you are thinking of whether to hold the position or book your profits, then you should look at whether one or many of the indicators are giving you different signals. So, as long as all the indicators are giving you the same signal, you can keep on holding your position. As soon as you see that some of the indicators are giving an alternate view, that the momentum is lagging, the momentum is falling off, or there is a chance of reversal, that is where you should book your profits. Okay, so to answer the question once again, following just one indicator is never suggested. You should at least have 4 or 5 indicators where you should, which you should follow simultaneously. Okay, so there was another specific question. I think we already answered that question, which is if the RSI is at 80 and the Bollinger Band is at the peak, then how we detect a reversal? The answer to that is, in such a scenario, it is not an indicator of a reversal. You cannot go short on that kind of a scenario. You'll have to wait for the Bollinger Band to show that the price is now moving below the 20-day moving average, or you have to wait for the RSI to show that the price is now cooling below the 80-70 level. That is where you can probably initiate a short. That too, a kind of a small correction kind of a short, not a complete bearish kind of a thing. As and when more indicators start showing you the same kind of pattern, that then your view becomes more and more confirmed. Okay, so another question was regarding what is the best indicator for short-term swing trade. See, indicators in the sense, there are a lot of indicators which are leading in nature. Typically, indicators like ROC, indicators like your moving average, the short-term moving average, that is, those are very good indicators where if you follow those indicators, you will get a very good sign of the reversal happening. But you have to understand that the more, let's say for example, there are 6-7 indicators which you are following, and 1 or 2 indicators are suddenly showing divergence. Now, based on that, if you initiate a trade, then the chance, if the trade goes right, then obviously there is a chance that you will earn much more than if you wait for the indicator to confirm. But then there is always a high risk that this can just be one time, small movement in the market which caused the indicator to show the divergence, and the market then may not reverse its direction and then keep on going in the trend, in which case you will end up making loss. So the better strategy is obviously to wait for multiple indicators to give you a signal and then initiate a trade. Doesn't matter whether you are initiating a short position or a long position, as long as there are multiple indicators which are giving you the same signals, you're okay. Okay, let me just open. Yeah, if you can see the screen, this is the Nifty. This is where the Nifty presently is giving us a rally. What we are seeing is this blue line is the 50-day moving average. Okay, so in any rally, there are short-term retracements. Obviously, it keeps on happening. But in this particular rally, we are seeing that every time there is a short-term retracement, the retracement is stopping at the 50-day moving average. So the 50-day moving average in this particular rally is very, very, very important right now. We are seeing that at least 4 times, clearly and exactly at the 50-day moving average, the retracement stopped and the rally resumed. Okay, so then this becomes your very good indicator. If you have to go short, they have to wait for the price to now go below the 50-day moving average. That is one way of looking at it. Then there are, as I showed, the Bollinger Band also. Right now, the price is at absolute peak of the Bollinger Band. If you see that the price is now reversing, and probably somewhere here the 20-day moving average will be there, and if it starts crossing below the 20-day moving average, then again there can be a short-term short that can be initiated. Yeah, so I think we covered most of the questions that came, other than the open interest, which we'll discuss at the end of the session. So you can start putting in other questions also if you have. See, if what I'm saying is not clear to you, you can keep on asking the questions, no issues. So the question regarding Bollinger Band, I hope it was clear. Okay, so if you can hear me now. Sanjeev, let me repeat what I just said. The trend line, once you have identified a trend and you see that the price is moving within the trend, you can hold on to your position, and then if you see that the price is moving, is trying to break the trend, you have to wait for a couple of days for the price itself to confirm itself that the trend has got broken. Otherwise, there is no, at times it happens that due to a certain spike in one particular day's movement or something, the trend line seems to get broken, but immediately the market tends to come back within the trend, within the channel. So that's why, to be on the safe side, the confirmation has to be done by the market itself. All you have to do is wait for a couple of days, or if you are talking about intraday, then wait for probably couple of minutes, or 5-10 minutes, and then if the price is immediately not retracing back within the trend, then you can say that the trend has got broken, and then you can say that the break is a valid one, to answer your question directly. There is another question put by Sanjeev, which is how to identify stop loss. See, stop losses are levels that you yourself have to decide and put. Like, for example, if Sanjeev, if you can see the chart that is open right now, as I said, the market in the last couple of months has been taking very, very good support at the 50-day moving average. So if you are long in the market, this 50-day moving average itself becomes your stop loss. So if you put a stop loss which is approximately 50-day at the 50-day moving average, obviously you have to trail the stop loss on a daily basis. Then you can see that even if the market is coming back to this 50-day moving average, is not breaking the 50-day moving average. So this kind of a stop loss is very, very good. So how to decide on what stop loss levels to keep is this is how it is done. You have to identify a trend which the market is respecting repeatedly, and based on that level only you have to put a stop loss. Okay, so Vaishali is asking what is Fibonacci. Vaishali, if you can hear me. See, Fibonacci ratio is something which is to explain the importance of Fibonacci ratios. It is something that is omnipresent within the nature. Okay, so anywhere if you look at let's say in the nature, like if you look at the trees, if you look at the human body, if you look at anything else, you will find that the shape, the size, the length, everything is governed by the Fibonacci ratio. So in a way, Fibonacci ratio is a natural occurrence. So the market players also believe that within the market also the Fibonacci ratios will pan out, and that is why there is a certain amount of let's say emotion, or a certain amount of importance that is given to the Fibonacci ratio. Now, what are the ratios? There are few ratios which are important. You need not remember all the ratios, because the ratios are actually derived from one another. I'll show you how. If you can see the Excel here, two ratios are very common, which is the 100-day and the 150, 100% and 50%. So if the price is moving in one direction and then it starts retracing, there are two levels, which is the retracement at 100% level and what is the retracement at 50% level, which are not related to Fibonacci, but these are very common in the market. So these two levels, you will obviously, it will be easier for you to remember. There is one particular ratio which you have to remember, just one, which is the 61.8% retracement. Okay, we just now saw in the chart that how this particular level, the market currently the level where the market is right now is at the 61.8% retracement level only. Okay, so the 61.8% retracement is a very critical level. Every other level is derived from 61.8. How? If you subtract 100 from 61.8, you will get 38.2. So this becomes, let me just bold this. This becomes another Fibonacci ratio. Then if you subtract 38.2 and 61.8, you get 23.6. You know, so to sum it up, these are the 5 ratios which are very important: 23.6, 38.2, 50, 61.8, and 100. Okay, so 50 and 100 you can remember easily. 61.8 is the one ratio that you need to remember. These two ratios are derived from 61.8 only. Okay, so what is the importance of this Fibonacci ratio is, what we say is, if there is a trend, okay, if there is a trend in the market, the trend is never on a straight line. It will always be like this. So which means once the market goes up straight, it will retrace. It will come down to certain extent, and then again it will resume its rally. Now, how much it will come down is something that the Fibonacci ratios, we have seen in the past that it respects the Fibonacci ratios. So typically it can come down to 23.6% of the previous rally, or it can come down to 38.2% of the previous rally, or it can come down to 61.8% of the previous rally. Okay, so this is how the Fibonacci ratios are important. So for example, if you have missed this rally particular, let's say for example, let me try and highlight this. So for example, if you have missed this rally and we are here right now, so what you can do is you can wait for this retracement to pan out, and you can do a calculation that what is the, let's say 23% level, let's say the 23% level is somewhere here, then the 38.2% level is here, the 61.8% level is here. So once the market starts retracing, you'll have to wait and see if it is taking support at this level. In this particular drawing, it is not taking support, so do not go long here. Again wait. Then the next level is 38.2, which is approximately here. So what we are seeing is the market has taken a support here, and then again it's resuming the rally. So at approximately this level is the right level to again go long and take advantage of this trend. You know, so this is how the Fibonacci ratios are used in the market. So Vaishali, if I have answered your question. Okay, so there is another question on how we calculate the Fibonacci ratio. Okay, typically the Fibonacci ratio has to be calculated based on in respect to a particular rally. So for example, in this particular drawing that we are seeing, a rough drawing, you know, starting from this point till this point is a rally. Then there are intermediate rally like from this point till this point. Okay, so let's take, so the Fibonacci ratio has to be with respect to a particular rally. So if we are seeing that we want to see that for this particular rally, that is for this particular rally, how much the market can retrace before it can resume the rally, then this rally, the low point of the rally and the high point of the rally becomes the basis for calculating the Fibonacci ratio. So for example, let's take an example that this rally was of 100 points. Okay, so then it can either retrace up to 23.6 point, 38.2 points, or 61.8 point. So those levels becomes some levels that you have to watch out for. And as soon as you see that it has taken support at somewhere near to those levels and then it is again reversing, So you can come to the conclusion that yes, the retracement is now over. It has taken a support at one of the Fibonacci ratios levels, and now the original rally, which was on the uptrend, is now resumed. Another question is what ratio we should look at. If the market is retracing, then at what particular ratio will the market, or till what particular level the market will retrace. Now obviously there is no predefined kind of this thing that the market will retrace only till 23.6% or 38.2%. We'll have to wait and see. It's always a wait and see kind of a thing. So if we go back to the practical chart, so for example here there was a rally from this level to this level, and then there was a short retracement. Now this retracement was probably at a, let's say, 38.3% kind of a retracement, and then it moved back. However, the next retracement was little far below. So the next retracement was till 61.8. So till what level the market will retrace and which ratio level will become important is something that you cannot know beforehand. You'll have to wait and see that till what level the market is going, and then it is coming down. In the beginning of the session, we discussed that this fall that we had seen in the market for the last 1 year, and then from the budget day, the rally that we saw, this was one level. If you can see the cursor here, this was one level at 8,000 where the 50-day or the 50% retracement level was placed. So what I mean, we could not conclude beforehand that the market will take a resistance at this particular level. We just simply had to wait. What we saw at the market first touched the 50-day or the 50% retracement level here, then it kept on testing the levels, and then it could not go past it, and hence it started coming down. Now once we see the market has started coming down, that is where the trade signal starts. So irrespective of whether it is taking the resistance at a 23% level or 38% level or 61% level, that is irrespective. What we'll have to see is at what level the market has taken a resistance and then now it is coming back. So immediately that level becomes your critical level. So the next time when the market started moving up, everyone was waiting for the 8,000 level to cross, because the last time the market was not able to cross the 8,000. So you can see that as soon as the 8,000 level was crossed this time, immediately there was a rally till the next 61.8% level, which is where the market is currently at. So 82.40, 82.30 is the level. So right now the market participants, what they are doing, they are now waiting for to see how the market reacts at this level. So we cannot beforehand say that the market will not move above this, or the market will definitely take a resistance at that level. That cannot be concluded beforehand. It has to be waited and seen. If we now from here see that the market is not able to take out this level, then definitely there will be a short that will be initiated, at least for the short term. Okay, so there is another very basic question, which is, please explain support and resistance lines. See, support and resistance lines are basically trend lines that you draw while connecting the the lows and the highs. So for example, in this particular rally that we are seeing in Nifty, if we have to draw a trend line, for example, from this point till this point, so what we are seeing is the market is taking multiple supports at this particular trend line. Okay, so anywhere within this trend line becomes your support zone. So if we see the market coming below this particular trend line, then we can say that the support level has got broken. Similarly, when the market was on a downtrend, if I have to draw another line, let's say from here to here, what we saw was the market was taking resistance at this particular line, and then here the market started breaking past that resistance line. So this particular line then becomes your resistance line. Okay, so support and resistance line is something that you yourself identify based on joining the highs and lows that the market is making on a daily basis. Surya, to answer your question, how Fibonacci ratio will be used for intraday, the way it is used remains the same. The only problem with intraday is that the rallies, the movements are very fast. So you really have to be on your toes. Like, if you initiate, let's say for example, in any intraday, if you are seeing there is a strong upward movement or the downward movement, and if you are waiting for if you are waiting to initiate a position on that particular direction, let's say for example, let's assume a scenario where the market is up for the day, okay, and you unfortunately were not able to initiate a position on the long side. Now you're waiting to initiate a position on the long side. So what you'll have to do is wait for the market to give a small retracement intraday. Now, as soon as you see that the market is starting to retrace, what you'll have to do is you'll have to plot a chart on the of the previous rally, the intraday rally that I'm talking about, and see where are the Fibonacci ratios placed. And then again, you'll have to wait and see if the market is breaking past the Fibonacci ratios. As long as it will keep on breaking past the Fibonacci ratios, you cannot initiate a long. But if you see that the market is taking a support there at the Fibonacci ratio, then that is where you can again initiate a long position. So that is how Fibonacci ratios can be used intraday. But again, as I said, since the movements are very fast intraday, you'll have to be really very quick in plotting the charts. Sanjeev's question is how to use divergence. See, you have to understand what divergence is. Divergence is a scenario where your price and your technical indicator are giving you conflicting views. So for example, you are clearly seeing that the price is moving up, or even if it is not moving up, it is within the trend lines that you have drawn. So it is still on the uptrend, let's say for example. But one or two indicators, technical indicators like the let's say the ROC or the RSI, it's giving a indication that the momentum is shifting. So that is where there is a conflicting views that is coming in the market, that even though the price is up, the indicators are showing a downtrend. That is what is known as divergence, and divergences are normally used to mark this kind of reversals only. Okay, so this is how divergence is used. You'll have to keep on seeing, following the indicators, and if you see that the indicator is giving you a contradictory view to the price movement, then you can say that there is a divergence that is happening, and that is where probably you can take a contra position also. Vishnu, I'm sorry, I'm not able to understand your question. Technical indicator values to be entered. Technical indicator values to be entered in it of ROC indicator. If you can just explain a little bit more as to exactly what you're asking, I'm not able to understand your question. Okay, another question that Vishnu has put is how to find MACD divergence. Now in MACD, MACD is basically used in three ways, because there are a lot of information that is there in MACD. If you recall, in MACD there are two lines. One is your the main MACD line, which is the difference between two moving averages. Normally the two moving averages are 12-day moving average and 26-day. It can be different days also, but the default setting is 26-day and 12-day. So the difference of these two moving averages gives you the primary MACD line. Then there is a signal line, which is the 9-day moving average. So the first indicator for MACD is when you see a crossover of these two lines. So if you are seeing that, let me try and draw a rough this thing for you to understand. For example, this is the this is the main MACD line, and this is your signal line. Okay, so the MACD line is above the signal line. Now, if the market has started moving down, then we'll see this MACD line going below the signal line. Now, as soon as there is a crossover here, then this becomes one indicator, kind of indicator within the MACD. The second is the divergence with the price. So if the MACD is, because the MACD is a lagging indicator, it takes some time to give you the indicator that the market reversal has happened. Basically, MACD is not used to know whether there is the reversal is happening or not. it is used to kind of confirm that the reversal has happened. Initially there will be a divergence with respect to price. That is, the MACD indicator will keep on showing up while the price will probably start moving down. So the divergence along with the price and the MACD is the second indicator that is used, and the third is something called as zero line, which is a straight line here. So if the MACD line is crossing below the zero line, this is also another indicator that the trend has got reversed. So three different things that are used in MACD. One is if there is a crossover between the MACD line and the signal line, or if there is a price divergence, or if the MACD line is crossing below the zero line. So three ways MACD indicators are used. Okay, another question by Vishnu is in the ROC indicator. See, ROC indicator is a momentum indicator, which means that it basically says whether the momentum is intact in a rally or not. So for example, if there is this rally that is going on in the market, okay, now at some point when the market will start reversing, it is said that before the price starts reversing, we'll find that the momentum has already reversed. In other words, the momentum with which the market was going up will not be sustained approximately at this levels, and then it will show that the momentum is shifting down. That is where, so the first indicator will be the momentum indicator, and then the price will follow. So ROC is one such leading indicator. It's a momentum indicator which shows that whether the momentum is intact in the rally or not. So if you have to see the ROC with respect to, let's say, the current Nifty scenario, see, right now what we are seeing is this is the current. If you can see the screen, Vishnu, this is the current ROC situation. So it is clearly showing an uptrend, and also the price is on an uptrend. So that what we can say is the momentum is intact. So there, based on ROC, there is no indicator to go short at this level. Okay. So, but then probably in a couple of days, if we see that the indicator is now starting to go down, even if we are seeing that the price is not coming down, the indicator is showing there is a change in momentum. That is a situation where you can either initiate a short or book your profits in your long. Sanjeev, what you are asking is something that we already discussed, that only one indicator is not enough. Okay, so if you are looking at any one indicator, and if you are asking yourself if that is enough, so the answer is no, it is not enough. You have to wait for other indicators also to confirm, and only then it is advised that you initiate the trade. Vishnu, if I have to give another example, ROC, see at this particular level, if you can see the chart here and my cursor, when the market, this was just when the market started, the rally started, that is just after the budget day. At this particular level, even though there was not a very significant retracement for the price, we saw that the momentum fell drastically. So if anyone was long or holding long, this was a level where he could have booked his let's say profits. And then again, when at this particular level we are seeing that the ROC is again going is taking a is resuming its uptrend, then again you can go long from here, and then the rally continues. So ROC is something which is a leading indicator. It gives you a sense of the momentum of the market. So if you are following a rally, whether the momentum is intact in that rally or not, or if the momentum is losing. So based on that, you can decide whether to initiate a fresh position, or if you are already holding a position, whether to book profits on that position or not. Okay, so we touched MACD, we touched Bollinger Bands, RSI a little bit, ROC, support, resistance, Fibonacci ratios, a lot of topics we touched. Anything else you want to know? from your syllabus? So we still have this question on open interest, which again I'll not be taking right now because it will unnecessarily break the flow of the discussion. We'll take it later, just before we end the discussion today. Okay, Sanjeev, just to answer your question on money flow index, I don't know whether it is part of your syllabus or not, but the money flow index actually is a very vast topic. Will not go in details. Just to understand the concept of money flow index, normally what is done in money flow index is in addition to the price movements, the change of volume is also taken into consideration. So it is also an oscillator kind of a movement where it will go up and then it will go down again. But whatever that you are seeing on the money flow index is not only a representation of the price, the volume has also been taken into consideration in that. Another question put in by Vaishali is, what is stochastics? Stochastics is again something to do with momentum only, wherein what we have basically what we try to figure out in stochastics is for a particular rally. Again, it is done with respect to a previous rally. So for a particular rally or for a particular price movement, where are we currently situated with respect to that particular movement? So for example, if I have to give you a rough idea, let's say for example, the market was moving up like this and then it came down and then like this sideways. Now, so for example, if we are taking this entire rally, so what we can see is we have come down a little bit from the highs, okay, but we are still on the upside only. I mean, we haven't come down like here, okay. So even if there has been a retracement, the retracement is not so much that we can say that the rally has ended. So what we can conclude is the momentum is still on the upside. Okay, so the calculation for stochastics is like that only, that it takes into consideration the low and the high for the period that in which you are calculating it. Normally the period, by default period, is 14 day. So for the previous 14 day, let's say for example in this example, this was the previous 14 day rally. So in the previous 14 day, this is how the market moved, and this is where we are currently. This is where we are currently. So where are we currently with respect to the previous 14 days market movement? So we are, as you can see from the chart, visually also you can make out that we are currently on the upper side of the rally only. So the stochastics will give you a high kind of number here, which indicates that the momentum is still up. Now, for example, if the market will keep on coming down, and let's say, for example, if we are here, then the stochastics will say that the market rally, the momentum has probably gone down, and the stochastics oscillator will then be like this on the downside. So even if the market is still above where it was on the beginning of 14 days, we are still above the 14 day, but the stochastic will fall drastically, which will indicate that the momentum has completely gone down of the market. So this is not a level where you should initiate a long. So that is how stochastic is used. Again, that is a momentum indicator. See, these stochastics, if you talk about stochastics, if you talk about ROC, RSI, all of these indicators, you'll have to really look at them together. I mean, you cannot isolate one of the indicators and say that just because the stochastics is giving me a low reading, I should probably go short on it or something. It is just one of the indicators. So if you look at all the indicators that we discussed today, starting from Bollinger Band, MACD, RSI, stochastics, then ROC, and then at least 3-4 of the indicators are giving you the same signal, then that is where you should, based on that only, you should initiate your position. So stochastic is just one of the indicators. It is a very good indicator because it's a momentum indicator. As I said, when a rally has to reverse, the momentum will first reverse and then the price will follow. See, this is the live example of the stochastic right now that is happening in the market. So what we are seeing at that the stochastic line and the signal line both are almost like together. So currently there is no trade that the stochastic is suggesting. If we see a crossover on the upside, which will obviously happen once the price will again start moving up, then we can kind of confirm that okay, there is a crossover, positive crossover in the stochastics. Similarly, we can also see that the ROC just above it is also giving a positive momentum. So 1, 2, 3, 4, different types of indicators will give you the same signal, and that is where you can confidently go long. Similarly, if the market has to come down, then you'll see that the ROC is starting to go down. The stochastic is also starting to go down. There is a negative crossover in the stochastic charts, and then you can probably go short a little bit. But since it's a overall uptrend rally, whenever you are going short, you have to keep in mind the Fibonacci ratios levels, and you have to make sure that as soon as one of the Fibonacci ratios are coming, you are aware or you are kind of ready to book your profits in case the market again takes supports at that level. So clearly stochastic right now, in the real market scenario, is not giving you any trade signal. So it is almost a no trade zone. The same thing is the Fibonacci ratio is also saying you the same thing, that right now there is a no trade zone. So wait for the market for another couple of days. Wait how the price moves, how depending on the price movement, how the indicators give you signals, and then probably you can initiate a trade. Okay, so once again to sum it up, we discussed a lot of topics today. We discussed Bollinger Bands. I hope that the doubt was clear regarding Bollinger Bands, how to initiate a trade based on signals derived from Bollinger Bands. Then we discussed RSI, ROC, MACD. 3 types of indicators are there in MACD. Then we also discussed stochastics, moving averages, trend lines, resistance, support, etc. So a lot of things we touched. Anything else that you still require some more clarification? So if there is nothing more you want to discuss within technicals, then I'll take the question of open interest, which is a little out of the topic today. Just to briefly discuss, open interest is something that we study when we study the derivative data. Basically, what happens is whenever you create a position in the market in a futures or an option segment, as long as that position is open, we say that is an open interest that has created in the market. Okay, so overall, when we see, open interest is something that we track to see that in which direction the players are adding their positions. So, for example, if the open position or total open interest in the market for any particular stock, let's say Nifty, is let's say 50 lakhs, and then next day we are seeing that the 50 lakhs has increased to 55 lakhs. So what we can conclude is more people have added to Nifty positions. However, we also have to see in which direction those positions were added. Typically, that is we normally see the price movement along with the open interest to find out that in which direction the open interest has added, and that is how the open interest is basically read. See, again, there is a question on put call ratios. I think we are really digressing from the topic today. These are not today's topic was not on derivative in this thing data. So what I'll suggest is you park these questions as of right now. We can probably take these questions in some other session. Put call ratio, just to briefly answer, is the put call ratios can be both in terms of volume as well as in terms of open interest. Okay, normally it is seen in terms of open interest, wherein we see that how much open interest is there in puts and compared to how much open interest there is in calls. Okay, so if you are seeing more open interest there in put than call, then the put call ratio will be greater than 1. What basically that says is a lot of people have accumulated positions in put. Now normally you might feel that that means that a lot of people have gone short in the market, but that is not the case. Because see, when you buy an options, buying an options is always easy because the premiums are low. selling an option is tough because that is where you need to park in a lot of margin money. Okay, so what happens is, if let's say you bought 1,000 or let's say 10 lots of Nifty put, then someone has sold 10 lots of Nifty put also. Now for you, the price that you have or the money that you have put in is only the premium multiplied by 10 lots. But for the other guy, he has to put in 10 lots worth of margin. So always an open interest is always seen from the seller's perspective. Okay, so if there is a lot of open interest there in put, which basically means that a lot of selling has happened in put. In other words, there is a lot of support that is there in the market. So when we see that the put call ratio is going above 1, we can say that there is a lot of support that is getting created in the market. However, if it starts going really above 1.4 or something, which means that there is a lot of accumulation, and that is where the market tends to give you a negative surprise, and then it starts reversing. Okay, so the put call ratio is something, the change in put call ratio is tracked to see if there is any change in the kind of trends that we are seeing. Currently in the market, you will find that the put call ratio is above 1.1, 1.12 is where the put call ratio is currently. Another question by Vaishal is how to read different types of candlesticks. That's a very open-ended question. Okay, see, candlesticks, there are two ways to read candlesticks. One is one candlestick at a time. The other is to look at the overall price pattern. Okay, so for example, if I look at this chart, the chart that is open with you. Now, one way to look at this candlesticks chart is if you simply look at the overall price direction. Okay, so if you can draw a trend line, you'll see that the price movement is up or down or whatever. The other way is to look at individual candles and figure out what exactly happened in that particular session. So for example, if I have to zoom here, I'll just give you an example, Vaishali. Okay, so see, this is a very good example. Look at this particular candle. It is almost like a gravestone doji. Okay, so this particular candle itself has got a significance. So normally this kind of candle is a bearish reversal candle, which means that normally the prices starts going down after this, and that is what precisely happened. So individual candles also sometimes gives you a lot of indicators. Like say for example this one. This is the hammer candle. So after a hammer candle, the price normally moves up, as we are seeing here. Okay, so this is how you read candlesticks. You have to know individual patterns and the significance of those patterns. Like another example is here. If you can see my cursor, this was the budget day movement. So there was a long tail, and then there was this thing. It is not a hanging, not a hammer precisely, but almost close to a hammer. And then because of this long tail, there was a clear indication of buying that happened on lower levels, and the buying continued next. See, another very interesting candlestick pattern is here. This is what you call the evening star. Okay, so there was a big movement in the market. Then there was another movement which the high of that movement was above the previous day, but the low was within the candle. And the next day there was a retracement which covered more than 50% of this particular first candle. So there was a clear indication that the rally, whatever was going on, had lost its momentum, and probably the market will go down from here. And that is typically what happened after that. And then there was again a hammer candle, and then the rally resumed. So you keep on getting these candle patterns in a day-to-day life, practical scenario. The important thing in technical analysis, especially with the candlesticks, is not to jump to conclusion. You have to always wait and see if the patterns are confirmed by the next day's movement. That is very, very important. Another question by Surya is which time frame to be used for candlesticks. See, there is no fixed thing. If you are looking at, like say for example in this chart, we are looking at a daily chart. So these candles are one day, representing one day. If you are looking at a weekly chart, those candlesticks will be weekly. The candlesticks can also be seen for intradays. It really depends on what kind of time frame, the trading time frame that you are talking about. Based on that, you can select whatever type of candlesticks that you want. So the time frame is absolutely flexible. The concept still remains the same, irrespective of whatever time frame that you have taken. Another question by Surya is, can we analyze the market behavior combining candlestick, RSI and Bollinger Band? The answer is yes. In fact, that is how you have to use it. I mean, as I said, you cannot rely on one particular indicator. So if your candlesticks, the patterns are giving you some sense that the market might reverse or something, it has to be confirmed by other indicators also. So you always have to use RSI and Bollinger Bands and all other indicators simultaneously. You cannot go by any one particular indicator. Why I am saying is this, because it increases your probability of going right. You may lose a little bit of a, let's say, profit because of that, because you are waiting for other indicators to confirm. So you're losing out on the opportunity that is there. But at least once you initiate the trade, chances of you going right will be much higher. Once you are confirming all the indicators, not all the indicators, but at least most of the indicators before initiating your positions. Okay, so just simply going by the candlesticks alone is not something that is recommended. You will have to go and see the RSI also, Bollinger Bands also. Different indicators has to be seen simultaneously. And I think the indicators that we discussed today are the indicators which are 90% of the cases used. There are other indicators also, but those are seldom used. Normally, these are the indicators that we discussed today that are popularly used. So if you have understood today's session, you are 90% technical analysis done. You can start analyzing the market from today, tomorrow itself, because you have understood 90% of the indicators, because these are the most popular indicators. Yes, another question is, when the RSI is above 80, still market is growing, then how to detect the pattern of reversal? As I said, when the RSI has reached 70 or 80, that in itself is not suggesting that there is a reversal. You simply have to wait, or you simply have to go to other indicators to see if there is some other indicator is giving you any reversal pattern. Okay, see, one suggestion to you, Surya, is don't start looking for indicators. You cannot first think in your mind that I have to go short and then start looking for indicators which are giving you a short signal. That is not the right approach. You have to keep your mind very clear without any predefined bias. So if you are looking to go short, then you'll try to figure out, or you try to identify indicators which are not very let's say dependent, and then you'll still initiate a short position. Rather, the best thing to do is remain with the trend. If you are seeing that the market is giving a positive trend, even if you have missed the trend, does not mean you'll go against the trend. Just remain with the trend. If the RSI is at 80, does not mean that you have to go short. If you do not want to go long, fair enough, because it's an overbought zone. So do not go long, but at least you wait for the RSI to give you another signal, or wait for other indicators to give you a negative signal. Only then you initiate a short. Don't start looking for indicators. Then that will create problems, because then you're already biased in your mind that I want to go short. Let me figure out at what level I can go short. Remain with the trend. That way you can the market will always be on your favor only. Another question by Rajeshri is, can we predict the start of the EXT? What is EXT? I did not understand. Reading the ending of candlestick pattern today. What I'm guessing is the question is, by seeing how the today's market panned out and the candle that it formed, can we predict how the market is going to behave tomorrow? If that is the question. So Rajeshri, the answer to it is, in candlesticks you definitely get an indication. But as I said, you have to wait for the market to confirm itself. Like, say, for example, in this particular case, let's say when you saw that there is a gravestone doji kind of a indicator that has formed, what you should do is, you should wait for the opening of the market to confirm that yes, today the market has opened below and it is staying below this level. So which means that the whatever candlestick pattern that you saw is getting confirmed. So that is when you initiate the trade. But definitely, even before the market starts, you will have some indication, but do not initiate the trade unless you get a confirmation. Because what happens is market is sometimes driven by news also. So if you go into the market just with one kind of with a closed mind, not with an open mind, then you will always get a negative surprise from the market. So rather let the market confirm itself, then you play the market. Surya, I think we are going round and round with the RSI example. My final answer to your query regarding RSI is, if you are seeing that the RSI has gone overbought or oversold, let's say if it has gone above 80 or at 80, or on the downside it has come to 30 or something, do not look at the RSI any longer, look for other indicators. Because now the RSI is at the overbought zone, it will not give you any further buy signal. Okay, going long based on RSI at that particular level will be difficult. So look for other indicators to give you a sense of how the market is supposed to react from there on. See, multiple times we have seen in the past that if the rally is a extended rally, for example, if it is falling, then it continuously falling. There is not, I mean, it is not necessary that the RSI, as soon as it touches 70 or 80, it will start reversing. It does not happen that way every time. Sometimes the RSI just stays there at 80 kind of level, 100 kind of level, 90 kind of level. Okay, it keeps on staying there. It will never be above 100, by the way. Okay, so once you see that the RSI reached that kind of a level, either on the upside or on the downside, forget about the RSI, look for other indicators. If on the RSI, if you are seeing that then there is a divergence, then the RSI is coming down from 80 level, then probably you can once again start looking at RSI. Do not limit your study of the market only to RSI. RSI is useful till one extent. There are other indicators which are also useful, so you have to look at them simultaneously. Again, to answer your question, Surya, which chart software is best for trading? See, there are a lot of softwares which are paid software, like Spider and all, which are good. A lot of indicators are predefined there. But if you are not buying any software, if you are dependent on the web-based tools that are available free on the internet, then this chart that we are currently seeing, if you look at the URL there, it's icharts.in. It is pretty useful. You can see this also. Okay, other than that, there is Odin, there is the different charts are there. So it's difficult. It really boils down to how comfortable you are with any. In any case, see, as I said, in any case, you are going to use, in 90% of the times, you are going to use the 7-8 indicators or the 10 indicators that we discussed today. These are most basic indicators. Almost all chart softwares will have these indicators. Okay, so if you are finding these indicators are not there in any of the chart softwares, then you can probably say that that software is not good enough. But other than that, all softwares are almost Unis based type. So I don't have any preference on that regard. Okay, Vaishali, there is Vaishali is asked about ADX and DI. Again, ADX and DIs are things which are not popularly or normally used in the market on a day-to-day basis. The calculations are also very complicated. So what I can simply tell you is these are indicators which tells you not only the trend but also the strength of the trend. So in a way, it is like a combination of the momentum indicator as well as the price indicator. So when you follow the ADX and DI, then you are not only looking at the direction of the price, but you are also looking at how strong the trend is. So if the ADX, the indicators, or there is a crossover in ADX and DI, then not only we are seeing that the trend is reversing, but we are also seeing that the momentum has shifted completely on the downside. Okay, another question is regarding concept of gap ups and gap downs and how it is calculated or guessed or whatever. See, gap ups and gap downs are not calculated; it just simply happens in the market. The reason it happens is because there is too much euphoria or there is too much panic in the market. If there is too much euphoria, you'll find a gap up. There is too much panic, you'll find a gap down. This is something that is not governed by any maths or anything. It's just simply a indication of the kind of sentiment that is prevailing in the market. Okay, so for example, in this particular chart that is open, you will find that this area there is a gap up, which was just after the budget session. So the red candle here is the budget day. The next candle, green one, is the next day, and then after the next day there is, I mean, the euphoria is so much that the market is giving a gap up. Now once the gaps forms, then the level starts coming in. Basically, the concepts of gap up, the why gap ups and gap downs are given importance is because what we say is the market was so much positive, you know, because of whatever news or because of whatever event, the market was so much positive that there was simply no trade done for that level. It simply skipped that level and moved on to the next level. So as long as the market is not coming down below that level, what we can conclude is the euphoria related to that event or that news is continuing. You know, on the other side, if we see that just after the gap up, maybe a few days after the gap up, the market is coming down and it goes below the gap up level, then that means that whatever euphoria that the market had was a short-term euphoria based on some, you know, speculative news or anything, which has completely been wiped off of the market, and now the market is actually going down. So the levels for gap ups and gap downs are like that. So for the level from where the gaps have started, that is where the important support levels or the resistance levels forms. So as long as the market stays above that level, we can say that the momentum is continuing on that particular direction. If it is a gap up, the momentum is continuing on the upside. As soon as the gaps are the levels from where the gaps created, they are breached, then we are saying that whatever euphoria was there based on that news or event, that has completely been wiped off and the market is now reversing. Okay, Surya, I hope I answered your question. It is not calculated or guessed. It simply happens in the market. After it happens, then we figure out the levels. See, eventually all gaps are filled. If you look at historically all the charts, you'll find that even if there are gap ups, big gap downs, eventually it is filled. Whether it will be filled within a month, within a year, we do not know that. It depends on what is the reason of the gap up. For example, if there is a gap up just based on, let's say, a small policy announcement in US or anything, then those are short-term gap ups. Normally, the market will tend to fill up the gap within a week or maximum 2 weeks. But then if there is a gap up based on a policy action or a budget session that has happened, which has got long-term implications, then the chances are that the gap will remain unfilled for a longer duration of time, unless the policy decision itself is reversed and then the entire economic scenario has changed, and then the market is again coming down and goes below the gap up levels. So it really depends on what is the reason of the gap ups. That will determine how long it will take the market to fill up the gaps. But historically, we have seen that eventually all gaps gets filled. Roshan, I'm not clear with your question. What is basic principle of bearish and bullish pattern of any stock? What exactly you're trying to ask? I mean, if your question is whether to know whether a stock is on the bullish pattern or the bearish pattern, as I said, we discussed so many indicators. You'll have to plot the price movement of that stock on a chart, and then you have to see whether the indicators are showing what kind of indicators that you are seeing. So if the indicators are showing bullish, the stock is bullish. Another very open-ended question from Vaishal is, what is technique for low risk trading? See, low risk trading, I mean, I don't know how to define this. One way, if I have to answer this purely from technical perspective, one way of doing a low risk trading is really waiting for all the indicators to confirm itself and keeping your targets short. Okay, so that way what you can do is you initiate the trade only after you are very sure that this is happening in the market, and then as soon as you see that your trend is confirmed and you're getting a return, you take the return and take out and get out of the situation, get out of the position. Then again wait for the market to give you another signal. After that you put in. I think that is one way of doing it. Obviously there is no hard and fast way of trading in the market where you cannot make losses, you can make only profits. So risk is always there. Okay, so risk and return goes hand in hand, we all know that. Surya, to answer your question regarding how many types are there and how they behave in the market, I think the behavior part we just discussed, that it depends on the reason on why the gap up is there, and from the level from where the gap happened, that is the level where the supports or resistance gets created. Now to answer your question, how many types of gaps? Normally, see there are, if you really look at a list of all the gaps, you will find a lot of theoretical gaps that are discussed. But broadly, there are two types of gaps. One gap is where the rally begins. A very good example is right in front of us in the Nifty chart. What we saw. Let me just widen this thing. Look at this. What we saw is the Nifty was falling down. Okay, and then there was a reversal. That reversal was triggered by a gap. Okay, so suddenly all the panic was gone in the market and there was a rush to buy shares, and as a result of that there was a gap. And this kind of gap is something that is there in the beginning of the rally. Okay, so these are the rally starts from this gap. These are called the breakaway gaps. Okay, then there is another gap which is the exhaustion gap. Probably one example is again in this same chart. If you look at the fall of Nifty, so when there was a panic selling in the market, normally that is where the market takes a support. And while there is a panic selling, chances are there will be a lot of gap downs in the market. So those type of gap downs tends to get filled up immediately, probably within a week or so, and they'll indicate that the market is the whatever trend, that if it is a downtrend then the panic is coming to an end, or if it is a uptrend then the euphoria is coming to an end. So that is like an exhaustion gap. It depends on how long it takes for the gap to fill. It is defined that whether it's the start of a rally or the end of the rally.